Welcome to the Plant Grow REIT podcast.
Welcome to Plant Grow REIT. My name is Kane, and today I'm here with James, the Director of Wealth. And today we're talking about something that often triggers a lot of emotion: market volatility. But here's the thing: volatility isn't always a bad thing. In fact, it can be a very good thing, especially for long-term investors. So let's dig into why. What do we mean when we say the market is volatile, James?
Volatility is, in a nutshell, ups and downs of the investment market. Very normal. It can happen during the day, lots of times during the day. Or in fact, it'll happen all day for most investment markets. It can happen over weeks, months, years. So the volatility can be a lot more extreme as you take a bit more risk.
Mm-hmm.
And that means you're going to get way bigger swings. So the ups and downs will be magnified. But it's perfectly normal, nothing to be afraid of. And really that's kind of the price we have to pay for stepping out of the shallow waters into the slightly deeper waters. But we need to do it. If we want to build our wealth over time, we need to invest in assets that are going to grow faster than cash and fixed interest and term deposits. And to do that, we got to take a bit more risk, and with that comes the volatility.
Why does market volatility feel so uncomfortable, James?
Well, we're human. And as humans, we're hardwired to sort of shy away from loss more than we embrace the gain. But, you know, that's emotional response leads to short-term thinking. And that's something we've got to try to manage because what often happens in those scenarios is when the market falls, the short-term reaction from a lot of people, particularly if they hadn't had any experience in this area, is to want to sell. It's common. And over the years, I've been doing this for 22 years.
Yep.
And it doesn't matter what the market correction is. It could be a big one like the GFC, or it could be just your run-of-the-mill one, because we have them every year. There's going to be some correction.
Yep.
And a 20% fall is not unusual over a course of a year. But the short-term thinking where people want to get out is as I mentioned, is where we want to watch out for, because a lot of people over the years have said to me, look, can we just sell until things get, and we'll get back it when things get better. So just so we can sleep at night, we'll move out of the market.
Yeah.
And then once things are better, we'll get back in. And that's the sort of thinking we want to avoid, because that's where people lock in a loss and they don't make it up and they fall behind. So I know it's human and I know it's natural, but our job as financial planners is to help people manage their behavior and make smart decisions, not foolish decisions which happen when people are panicking.
Yeah. So, James, how can volatility work in an investor's favor?
Well, volatility creates buying opportunities. When markets fall, assets become cheaper. So if you're contributing regularly to your superannuation or any other type of investment plan, you're buying more units when the prices are low. And this is known as dollar cost averaging.
So does this mean that people shouldn't worry about falling markets?
Oh, not necessarily. It's okay to feel uncertain because we're human after all. I think we covered that earlier, that it's a natural human response. But if you have a long-term in place and you've got goals in mind, then the best thing to do is stay the course. Because if you don't stay the course, obviously you're not going to be able to build wealth. So the idea is to manage your emotions. And that's the hard bit. And that's one of the primary ways we add value to people. It's not necessarily just picking the things that they're going to invest in or the investments. It's helping them manage their emotions. So making, as I mentioned before, smart decisions. Because when your emotions are all over the place and you really just don't want to be there, it's easy just to walk out the door. And our job is to keep you in the room investing so you can take advantage and build your wealth over long term.
Yeah. So what you're saying is that worry is normal. It's about how you deal with it. Correct.
It's very normal. It's like when markets are up, you're very confident. And then you can also make silly decisions in that sense too. That's where people bring themselves unstuck. When markets are going up, it's more of a euphoria rather than fear.
Yeah.
And their confidence level is really high and they take more risks than they would normally do because the fears disappeared totally and the greed part of the equation's taken over. And it gets even worse because they may then want to use leverage as well, so borrowing. So they may then take more risk in the type of assets they wouldn't normally invest in, plus they start using borrowed money, and that can come unstuck as well. So not managing your money, you can on the greed side, you can over leverage yourself, take too much risk, and then when it does fall, then you then retreat to the fear place, and now you're selling at a loss. So we want to manage both sides of the coin for you.
Yeah. Can you explain to me dollar cost averaging in simple terms?
Yep, sure. It's when you invest the same amount regularly, month in, month out, year in, year out. It doesn't matter what the market's doing. If it's up, you still invest the same amount of money. And if it falls, you invest the same amount of money. So it's not something where you make a conscious choice about what you're going to put into the market. You simply just invest. And it is a very useful tool to use because it takes the thinking out of it. And as soon as people start thinking, they get a bit more analytical. And that's when they actually sometimes can not make any decision at all. So we mentioned previously the greed and the fear. We can make good decisions. I mean, bad decisions really for those type of scenarios. But another type of decision is doing nothing, not running away or embracing extra risk or leverage, doing nothing when you should be doing something. So dollar cost averaging is fantastic because you don't have to think, you just do. And the beauty of that is it helps you make sort of regular contributions to something that sometimes you wouldn't want to do. When the markets fall, quite often people won't want to invest. They'll go, it's not a good time to invest. Not a great time. Or when they're really high, they'll put extra in. So the dollar cost averaging, once again, like we said in the previous segment, takes all the decision making out of it, and you buy when you're scared, and you don't buy too much when you're greedy.
Yeah.
Perfect outcome for you.
There you go.
So we'll talk about an example, Kane, of what that would mean in real life, in real money. So it's like superannuation is probably the best one because everybody's got super if they're working. And they're putting in the employer's putting in a contribution for them every single month or quarter. So the money goes in and it's, as I mentioned, the same amount of money. And most super funds have units. So you have like the balance fund and you've got a certain amount of units this month. So you are buying more units each month with your contribution. So when the market's up, your superannuation contribution doesn't buy you as much as it does when the market's down. So it's just a regular process. If the market stays the same 3 months in a row, unlikely, but and the unit price does, you get the same amount of units. But when it goes up, you get a little bit less, and when it goes down, you get more. So it's effectively that's what it is. You're just averaging your returns over time. But the beauty is when you're buying all of these assets cheaper because the markets have fallen, you are actually, when they go up again, you've got more units than you would have otherwise. Because the people who don't dollar cost average will decide, no, I'm not going to invest because the market's not right. People who do, they've got more. So when it goes up, their overall balance is going to go up quicker.
Yeah, smart. So, James, what should clients do when markets do fall?
Well, I would think the first thing to do is don't panic. Don't panic would be my first suggestion. And it's easier said than done because there's a number of factors you're dealing with. One, your own emotions. Two, wherever you go when the markets are down, particularly, and we're talking at an amount where people notice. Because they are down regularly, but most people don't notice because they're not looking at it all the time. But we're talking big falls. When you got big falls, your problems are not only yourself, but all the people that you deal with who invest as well. They'll be talking about it, and they'll be maybe they'll be not trying to sway your mind, but putting more negative thoughts in because they might say, "I'm going to get out. I'm going to sell now, and then I'm going to wait till it gets better." Then you think it's not a bad idea. But you've also got the news, the newspapers, online. You've got the radio. On the way to work, the news is going to have headlines about market falls and people losing money, and have experts on going, well, it's we've lost all this money and They don't just say percentage. It's not like 5% falls today. It's billions wiped off the market. It does sound scary. And then in the Herald Sun or The Age, you'll have a picture of a big bear just dragging your returns down. And it can be scary for people. So don't panic, number one. Number two, remember you got a plan. There's a purpose to do this. We are not investing for today. It's for down the track. And if we want to build wealth, this is going to happen. And the thing is, it's going to happen every year. Not necessarily a GFC type fall, but you're going to get a decent correction every single year.
Yeah.
And every period of time, maybe 5, 6, 7 years, you're going to get a big fall. And at least once or twice in your journey, you're going to get a really big fall. And that scares people. But remember the dollar cost averaging, we're buying more. So when we come out the other side, we've got heaps more units than we would have otherwise. So this is the perfect approach for that type of investment outcome in investment market. Then I would say contact your advisor, because that's one of our core jobs, is to manage your emotions. Because what we're going to do is we're going to say, Mr. and Mrs. Client, this is perfectly normal. This happens a lot. Great opportunity to buy. Yeah. So we'll actually be the ones positively talking to you when everyone else is talking negative.
Yeah.
We'll be the ones saying, this is a great time to buy.
Yeah.
Let's buy. Let's make sure we buy as much as we can, because we want to build our wealth. We've got a plan and we want to stick to it. And we're going to reassure people that what's happening is quite normal and their investments are sound. The actual investment portfolios are fine. Just because the market thinks Commonwealth Bank's worth 10% less today than it was a month ago, that doesn't mean the bank itself's changed. It doesn't mean the bank itself's got problems.
Yeah.
It's perfectly fine. So I would just say to people, buy more. And eventually, when they're down the end of the track, when they retire, they'll be glad they bought more, because they'll have a lot more at that point.
Yeah. Do you think that this approach has worked well in the past?
Yes, because that's why we use it. There's a lot of evidence to suggest it works well, because if you think about the share markets particularly, the share markets really just reflect the performance of the economy and the companies in it, particularly the companies in the share market who make it up. Now, you have to remember those companies are going to constantly try to improve. So every year, they are, regardless of what the market's saying about their value, they are earning a profit, most of them. They don't pay all that profit out to the investors. So they'll pay a portion of it out. So if you think about going back to Commonwealth Bank, they'll pay maybe 70% of their profits to shareholder investors and keep 30% and reinvest it back into the business to grow it. So it's bigger each time. So effectively what they're doing with that money is they're using it to perhaps invest in new computer systems, or maybe some AI technology, or better sort of performing key people they can get access to in the market. It's going to be some form of buying more assets to improve the value of the business, and they're all doing it. They're all cutting unnecessary costs. It's a bit like budgeting, really. We're cutting unnecessary costs and we're trying to grow our income. And by investing constantly into the business, a portion of their profits, they grow the value of the business. So effectively over time, that business is growing, even though the market doesn't have anything positive to say about it. But when the market is finished falling, because there's only, you get to a limit when all the sellers are finished selling and there's only buyers left.
Yeah.
When they buy, those companies that were there before at a higher price, they're still churning out profits at a lower price.
Yeah.
So over time, that the market will reflect that. They'll say, hey, this is a profitable business, and they'll give it a higher premium. And that's what effectively happens across the whole stock market. So it does go through its wobbles over time. Maybe it gets a bit expensive. The market sells it, but these companies are constantly improving. They're constantly getting more and more value. And effectively, the market recognizes that. And over time, that's why it grows. It keeps growing. And most of these markets, the other thing to realize is these indexes like the All Ordinaries or the ASX 200, so the Australian stock market 200, top 200 companies, they go through periodic rebalancing. Yeah. So the actual worst companies get booted out and new, better companies get put in. So it's constantly getting rid of the bad companies, putting new ones in. So over time, it's growing and growing and growing, and the price reflects that. So as I say to people, is take advantage of the falls. Take advantage because those companies haven't changed. They're still good companies. Just the price is cheaper. And when you go shopping, what do you do when things are on sale? You tend to load up,
Yeah.
particularly if it's something you're going to have. We know it's like if you eat tuna every day and it's half price, buying
Buy a couple extra cans.
well, exactly. You can buy twice as many when it's half price.
Yeah.
And the same with the shares. And you're going to need the shares later on to retire on. And that's going to provide you with a nice, comfortable retirement. The more of them you get while times are cheap, the more comfortable your retirement is.
Yeah.
So historically, yes, it's worked because that market has kept going up and up and up over time because those companies that make it up are growing in value over time.
Yeah. So next time you hear the word volatility, remember it doesn't have to mean danger. It can mean opportunity. With the right plan, guidance, and mindset, you can ride the waves and build lasting wealth. If you'd like to talk about your investment strategy, your risk comfort, or how to make the most of market movement, reach out to us. We're here to help. Don't forget to subscribe, share with a friend, and we'll see you next time. Thank you so much, James.
Thanks, Kane.